So welcome everyone to Saving for Retirement. We're going to be going through the Social Security and the Swiss Pillar system. And tonight I'm joined with Selim Bucher, and we'll go through and do our introductions in just a second. But we're going to start off with just a quick disclaimer. Just a reminder that Selim and I are not your advisors. This is just general advice that may or may not be applied to your unique situation. Be sure to speak with your own financial advisor, accountant, and lawyer for advice directly related to your situation. And thanks again for registering for this live webinar and supporting the American Women's Club of Zurich. You will receive a copy of this replay in a few days. Okay, so I'm Arielle Tucker, and I'm your co-host tonight, and I'm here with Selim. And like many of you, I am a U.S. expat living in Switzerland, and I've been personally and professionally exploring cross-border tax and financial issues for more than 15 years now. I own and operate Connected Financial Planning, a fee-only financial planning firm. We say fee only because we are only compensated directly by our clients. We do not sell any products. I write quarterly for Bloomberg Tax, and I've been featured in a number of media outlets, including CNN, Yahoo Finance, and Consumer Affairs. Please feel free to connect with me or Connected Financial Planning on LinkedIn and Facebook, where I engage with the broader expat community on tax, financial planning, and general expat considerations throughout the week.
My name is Selim Bucher. I'm the founder and partner of TaXperts. We are a tax advisory firm based in Switzerland, offering Swiss individual tax services and also U.S. tax services. So we have many clients from the U.S. living in Switzerland, where we support on both sides. We are a team of 10 people, and we predominantly focus on expatriates. So people from abroad coming into Switzerland and living and working here. If you have any questions on your personal tax matters, feel free to reach out to us either on our website or on our LinkedIn, or you can send also an email directly to me.
Great. Thank you so much, Selim. And I'm excited because, Selim, this is our third year doing this presentation for the American Women's Club. And I'm especially excited because we have so many updates this year to go through on both the US side and the Swiss side. So I really appreciate you taking the time and coming in and just giving us some more education about the Swiss tax and financial system. So
yeah, of course.
Our agenda for
tonight. Thanks for having me.
Here's our agenda for tonight. We have a lot to get through in the next hour. This is going to be really jam-packed. We're going to try to move at a good pace because we are going to be sure to provide a copy of this to you for your records, so you can watch this at your leisure and just go through it again. Because there is, the understanding the U.S. system, the Swiss system, how those two things interact. It's a lot to consider as you plan and prepare for retirement and even in retirement. So starting off, if this is your first introduction to the Swiss pension system, don't worry, because the concept is actually very similar to the U.S. system and actually many other countries. Most countries have something like this 3-pillar system. So pillar 1 is essentially Social Security. And it includes the survivors, unemployment, maternity, and disability insurance in Switzerland. Pillar 2 is the Occupational Pension, and this is mandatory in Switzerland. The equivalent program in the US would be something like the 401k or the 403b, but in Switzerland, this program is a mandatory, and the contribution percentages is based both on your employees' income and their age. And so one thing I always find really fascinating in Switzerland is that Pillar 2, your pension contributions increase as you get older. And then finally, we have the Pillar 3. This is an optional supplementary savings that is tax deductible in Switzerland. The equivalent program in the US would be something like the traditional IRA. We're going to go more in depth into each of these pillars in the coming slides. This is just kind of a starting overview of what this 3-pillar system looks like. So one of the things that I found surprising when I first moved to Switzerland was that the Pillar 1 so Social Security, Swiss Social Security, it's really set up to ensure minimum existence. And so as of 2025, the max benefit for the Pillar 1 was only 30,240 Swiss francs, which, if you compare that to the US maximum Social Security benefit, that was over $61,000. So this Swiss Social Security is like half of that. The US is just much more generous with their inflation adjustment as well. We had an inflation adjustment for US Social Security of 2.5% in 2025. And then back in 2023, when we had all that inflation in the United States, the inflation adjustment was 8.7%. And Switzerland has really not had these same inflation adjustments in recent years. I think most interesting was just this year in 2025, we had a 2.9% adjustment. So we'll be sure to let Selim discuss that adjustment in some more detail in the coming slides.
Yeah. And
Pillar
maybe
one.
maybe
Yep.
maybe also something to add, like for the Pillar 1, what is very different from the US, it's like the contributions are uncapped. Whereas the benefits are even
Oh,
lower than
yeah.
in the US,
Hmm.
the contributions are uncapped, so regardless of the income that you earn.
Yep, that's a very important point. So, as many people know, in the US, if you make up to around, I think, 164,000, again, it increases a little bit. After that, you don't have to pay into the US Social Security system. And so, if we think about why the US Social Security system is so underfunded, we're like, okay, you're capped, your income contributions are capped, and then the benefits that you get are so much higher than most countries in the world. They're very, very generous in the United States. Pillar 1 in Switzerland, it's also the most aggressive tax department. Salim, do you want to talk a little bit about that?
I mean, so yeah, so in terms of like collecting the contributions, they really want to ensure that the employers are contributing to the system, because the concept of the Social Security concept in Switzerland is a very protective system. So they want to protect the labor force in Switzerland. That's why there's also usually like the employers get audited on a frequent basis. It's usually between like 2 to 5 years, where the Social Security authorities, they're going to review if the respective contributions have been remitted. And you as an employee, you have actually the possibility to review that as well. So if you're not sure if your employer remits the Social Security contributions that are deducted from your paycheck, you can request a account statement from your Social Security account to review if the contributions were remitted and also accounted in your personal Social Security account. Because if that did not happen, then you could notify the Social Security authorities, and then they would investigate why this has not happened, and if the employer did not pay that, and you can prove that you have contributed, then the contributed amounts will still be credited to your accounts, even though the employer might not have like remitted it to the authorities.
Um, and then just jumping a little bit over to the Pillar 3, I think it's important to note that, the Pillar 3 does exist. We'll talk a little bit about why we don't recommend that most US citizens contribute to a Pillar 3, but just Salim will go in a little bit about some of the changes to the Pillar 3 program in the coming slides. So let's go to some of the updates. And some of these updates started actually last year, but I think it's still good to include these as well.
Yes, I mean definitely, because it still affects like a lot of people and will affect a lot of people like for the future. So what happened as of 2024, there was a so-called AHV reform, so a Social Security reform, which changed a bit the entitlements for Social Security benefits. So the authorities, they introduced certain flexibilities in one way. On the other hand, also though they aligned the retirement age for men and women. So now the official retirement age, or how it's called now in Switzerland, it's called reference age, not retirement age anymore. It's 65 for women and men. In the past, it was 64 for women. So there is a transition period for women that are born between 1961 and 1963, where there's a gradual increase of the retirement age. What has also been introduced is a flexible retirement possibility, meaning it is possible to take early retirement. So the earliest is 2 years before the official retirement age, so at 63, or there's a possibility to postpone your retirement up to 70. What is though also possible within that 7-year window, you can take a so-called partial retirement, meaning you could say, I would like to get 20% of Social Security benefits or up to 80%. So you can also have 50% or 60%. So this is fully up to you, whatever needs fits you best. So there you have full flexibility. Either you can have no benefits or 100% of benefits, or between 20 or 80%. What is important to know is that if you take early retirement, that will lead to a reduction of the benefits. And if you decide to take a retirement at 63, the reduction will be roughly 13.6% for the rest of your life. So it's not only for 2 years, so the benefits will be cut for the rest of your life. If you decide to postpone the benefits, then you will get a supplement, which is roughly 5%, 5.5% per year, up to 31.5% if you decide to postpone for 5 years. Also, if you decide to postpone, this will help you to increase your benefits, because the contributions that you are making through the postponement will still be counted to calculate the Social Security benefits. What a lot of people don't know, and what is very, very important if you decide to postpone, is that you need to notify the Social Security authorities that you would like to postpone your Social Security benefits. If you don't do that, so you have 12 months since reaching the retirement age. If you don't do that, then even though you don't collect any Social Security benefits at 65 or 66, you will not get the supplement in addition, because they mandate that you have to notify the authorities that you would like to postpone it. What is also important to know is that even though you reach the retirement age and you continue working and generate income from gainful activity, you're still subject to Social Security contributions. So you will not be exempt from it, even though you're 70 years old or older. So you still have to contribute to the Social Security system.
Yep, great. Thank you so much. So we'll go to the next slide with the 2025 Social Security updates in Switzerland.
Yes, so there has been further updates. So as Arielle, as you already mentioned, that there has been an adjustment for inflation. So the Social Security benefits or pensions have been slightly increased. So in Switzerland, the Social Security benefits or the retirement pension, there's a minimum and there's a maximum amount that is paid out based on certain factors. So the monthly minimum amount has been increased from 1,225 to 1,260, and the maximum amount has been increased to 2,450 to 2,520 Swiss francs. Those adjustments in average happen every 2 to 3 years, but the adjustments are usually somewhere between 2 to 3% and not more. A big change that has been introduced in 2025 is that now it is possible to make so-called Pillar 3A buybacks. That means that you can buy in Pillar 3A contributions that you did not buy in the past. And the first time you can actually do that is as of the tax year 2026, meaning in case you did not make a Pillar 3A contribution in 2025, then it's possible to make a catch-up contribution in 2026, meaning that you could basically make a contribution for 2025 and 2026 that will be then accounted for in your 2026 tax return. And that's a big change. And this can go back to up to 10 years, but it starts as of the tax year 2025, meaning in 2026, you cannot make a buy-in going back to 2024 or 2023. It's only 2025. So meaning the 10 years will only be coming into play like in the future, like if you're in 2030 and you did not make contributions in 2025, 2026, 2027, 2028, 2029, then you could do a buy-in, a Pillar 3A buy-in in 2030 for the last 5 years. I mean, there's some additional rules around it, but I would really suggest that if this is in interest for you, reach out like to your tax accountant to discuss the details.
Yeah, and I wanted this in the slide because I wanted it for completeness. But again, we'll go through why we should not do Pillar 3A contributions for US people. But so many, I know of both of our clients are married to Swiss individuals who do make these contributions every year. So this is why we wanted to have it as part of the presentation tonight. So now we're going to talk a little bit more about the second pillar. And this is what most people are familiar with because they see that deduction coming out of their pay slip, their loan house vice every month or every year. So again, the employee and the employer are both contributing. And this is generally taxable because these Pillar 2 accounts are immediately funded and vested in Switzerland. There are, it's important to read the documents that you have. Occasionally, I have come across some Swiss pension plans that are actually set up like defined benefit plans, and those may be treated differently, but that's not the focus of this presentation. I'm really talking about the majority of most employees who are here working for Swiss employers. Generally, those Pillar 2 pensions do not meet the definition of a U.S. qualified plan, and therefore they are taxable. So the employee contributions are never tax deductible for U.S. tax purposes. So we'll see this in the next slide, but they are deductible for Swiss tax purposes, and then the employer contributions are taxable. And if you have earned income on your pension assets, for most people, you're going to see that every year you get like a little bit of interest. That's also going to be taxable. So it becomes really important to track your U.S. tax basis, which is made up of your employee contributions and your U.S. tax employer contributions and earnings. And that's because the tax basis that we have on the U.S. side does not match the tax basis that we have on the Swiss side. So let me just show you what I'm talking about here. Okay, so employer contributions for Switzerland are not taxable. In the United States, they are taxable. Employee contributions are deductible in Switzerland. They're not deductible in the U.S. Annual earnings, not taxable in Switzerland. They are taxable in the U.S. Risk insurance, I generally look at that line and I don't assume that it's taxable. You might be working with an accountant who does determine that is taxable. So that's something that you should make sure you understand. Distributions in Switzerland. So if you take a distribution of your Swiss pension and you are a Swiss tax resident, from a Swiss perspective, they've never taxed you on any of this. So now that's going to be taxable at retirement, whether you take a lump sum or you annuitize it. And then from the U.S. perspective, it's only going to be taxable if it exceeds what you've paid tax on. Okay, and then we also have a lot of conversations about, should I make additional Pillar 2 buybacks? And again, that is deductible if you're the employee making those buybacks in Switzerland. And then on the U.S. side, there's not going to be any type of deduction for you. The funds that you would used to do those Pillar 2 buybacks would be taxable from a U.S. tax perspective. So this is just kind of puts a little bit of some simple numbers to what we're talking about. So in Switzerland, if you have wages of about 100,000, Your Pillar 1, so your Social Security, that is going to be deductible in Switzerland. Then we have our Pillar 2 contributions. The employee contributes, let's say, $10,000. The employer puts in another $15,000. Your total taxable compensation in Switzerland is going to be 84,700 Swiss francs. Okay, then we have the US side, right? So we had the same wages, the same starting wages. We have 100,000 Swiss francs. The Pillar 1, the AHV, the Social Security, that is not deductible on the US side. So then we also have the employee contributions, again, not deductible from a US tax perspective. And then the employer contributions become taxable. And so now from a US perspective, we've had earned income of 115,000 Swiss francs, right? And we haven't even factored in the foreign exchange rate difference yet. So even though our initial gross salary is the same, there is now a 30,300 Swiss franc difference in the taxable compensation. So this is something that just we see accelerate as your income accelerates, as you're older and you have higher Pillar 2 contributions, we just see this number increase.
Yeah, and maybe to add quickly there, what is important, or what this table really like illustrates is that when we talk about tax rates, the tax rates might be comparable in Switzerland and the US in certain circumstances, but the US tax might still be significantly higher. And the reason for that is because of the differences of how the Social Security and the pension contributions are treated in both countries.
Yes, exactly. Yeah. And that is a great point because if you looked at the total, federal, cantonal, communal tax rates together, they are actually very similar to U.S. federal rates. They vary obviously by canton, but it's similar. And then we just don't have enough foreign tax credit to offset. And so for many of the clients that we're working with, they end up having an additional tax liability. And this is why. It really comes down to a tax timing difference. Okay, so I just want to run through some examples of what a Swiss Pillar 2 statement looks like. I always say that every pension statement is like a snowflake. Each one is very unique. And most often these documents are actually going to be in German, French, or Italian. And so this one's a really nice example because it is in English. What we're looking here is we can see the retirement assets at the beginning of the period. So we see this 136,000, and then we see the retirement assets at the end of the period. And so it makes for a really easy calculation so we understand what is the overall growth of the plan, what did the employer put in. We can see that very clearly here. We have contributions, we have the employer contributions and the employee contributions. We have the risk contribution here. Oftentimes that is borne by the employer. So you can start to see how much was actually put in and what was the overall growth of the plan. And that is how you can calculate how much did my employer put in, how much did I put in, what was the overall growth. And that's how your U.S. tax preparer will report your contributions on your U.S. tax return. Okay, this is another type of a Pillar 2. So this is actually a supplementary pension statement. So many senior staff members in Switzerland have a supplementary pension. And many employees that I talk to don't even realize that they have this like secondary or supplementary pension statement. So it's really important that you double check. If you are a high income earner, if you are on the executive team or senior management, it's very likely that you actually do have a supplementary pension plan. Oftentimes with the supplementary pension plan, there's no additional employee contribution. It's just your employer making those contributions. And one of the things that oftentimes clients will realize that they have these supplementary pension plans when they go to change jobs. And then all of a sudden they realize like, oh, we had this other supplementary pension plan. And from a Swiss tax perspective, this makes a lot of sense, right? This income isn't taxed by Switzerland when the employer is giving it to the employee. It's not taxed until retirement. So from a Swiss perspective, this makes sense. Unfortunately, from a US perspective, you have to pay, this is just additional income that you're receiving that you have to pay tax on. Anything to add, Selim, on supplementary pensions that anything you want to add or that you
Y-
see?
y- Yeah, maybe just like the reason why there is these supplementary pension schemes is because those pension schemes provide more flexibility for the employees because they have a greater influence on how their pension assets are invested. Meaning, normally in the basic pension plan, you as an employee cannot decide how your funds are invested, and it's fully up to the employer or the employer pension fund on how your pension assets are managed. I think that's also quite different from how it is in the US. So the supplementary pension plans, oftentimes there, it provides greater flexibility to the employee because certain decisions can be taken by the employee in terms of like how the funds are invested.
Oh, that's a great point. Yeah, and correct me if I'm wrong here. With the pillar two, like the basic plan that all employees have access to, the guaranteed interest rate there is 1%. Is that correct?
Well, that's the minimum interest rate that needs to be credited by the pension fund. I have to say, a lot of the pension providers they provide a higher interest, but they don't need to. So
Yeah, I think it's an important point to just look at look at your pension statement and see what you if you can gather what rate you're getting. If your employer is only giving you the 1%, maybe it doesn't generally make sense to do anything else with it. But I have seen some really good pension plans where employees are getting like maybe 7% in their pillar two, and that's I think that's a really good return. Um, okay. So then I also wanted to just kind of give an example of what this ends up looking like on your salary certificate every year. So you're going to see this on line 9, the AHA contribution. You're going to see that's the pillar 1 contribution. And then on line 10.1, you're going to see the employee contribution that you make. What you don't see on this salary statement is the employer contribution. So you always need to make sure you request your Pillar 2 pension statement. Oftentimes you can download those or you get a copy sent in the mail, and that arrives toward the end of January, early February for the year. Anything else to add here?
no, I think that summarizes pretty well what the Swiss salary certificate like shows, and that it's really important to ask for the pension certificate statement to identify the employer pension contributions. There are some employers actually that provide a specific statement for U.S. taxpayers outlining like the relevant contributions to be added in the U.S. tax return.
Okay. And so, again, if this is one of the questions that I get from our clients is, how do we calculate this U.S. tax basis? It's something that you need to get comfortable with, or you need to make sure that you're working with the right professionals. So someone like Selim and their team at the TaXperts, they specialize in Switzerland, and they can help you make sure that you're tracking your Swiss pension basis correctly. If you're working with a US-based preparer and you are their only Swiss client, this is like a very much a red flag that they probably are not reporting this correctly. We often have clients who are moving into Switzerland and they're still working with their parents' accountant in small town USA, and they're just not familiar with how the Swiss pension system works, and it's really not intuitive because in a lot of the surrounding countries, the pension systems are recognized by the treaty and therefore they are deductible. It's really, the Swiss pension system is just kind of an outlier here. So it is very important that we keep really good records of everything. So making sure you're keeping your employer contributions, that you're tracking how the income was taxed on the return. Oftentimes your accountant will have that as like a separate line. So it's really clear to track what was taxed on the US side. The employee contributions are not deducted on the US tax return. That's really important to note. And you can always like very quickly double check that. The pension earnings, sometimes I see those reported on Schedule B where you would see interest, and other times I just kind of see them lumped in as part of the employer contribution. And then if you do have any type of distributions, so for example, if you were to, take a distribution, if you wanted to purchase a home or you were in retirement, that would reduce your US tax basis. So it might be like, again, a tax timing difference. Something is taxable in Switzerland, but you've already prepaid the tax on the US side. Anything else to add here, Selim?
I think maybe the only point on the distribution is if there's distributions from a Swiss pension plan while when you're back in the US, then you might actually avoid the timing issue of the taxation, because in a lot of cases it's possible to exempt those distributions from Swiss taxation.
Yeah, that's a great point. We have a slide on that coming up, so we'll talk about that a little bit more as well. And so this is something that I'm always telling our clients to be looking for from their US tax professional. Are they telling you how much you contributed? Is there a separate line for your pension contribution? Just to make sure that you have your records in order. Because if you contribute into the Swiss pension plan for 10, 20, 30 years, you really have to understand how that's going to be taxed, when it's going to be taxed, to avoid double taxation. So let's talk a little bit about taxation at distribution. This kind of goes back to what Selim was saying a moment ago. So distribution, when you're permanently departing Switzerland, so this is very common for US expats that we're working with. They come here for 5 or 10 years, and then they go back to the United States. So at that point, the only amount that is taxable is the amount that is in excess of the US tax basis. So if you have been, contributing $10,000 a year every year, you've always reported that correctly. Now your account is worth $100,000. You can take that distribution and there's no additional tax. A very common question that I get is, okay, can I take my Swiss retirement account and roll that into my 401k or roll that into an IRA? And the answer is no. They're two different types of accounts. You can't combine them. Basically, you would take a distribution of your Pillar 2 account, and then you could use that money for whatever you wanted to. You could go and put that into a taxable brokerage account and grow and invest it. You also don't have to be at retirement age if you are permanently departing Switzerland and you're going to the US. So the US is one of the countries that you can go to and take your Pillar 2. If you are a US citizen, you're in Switzerland, you're permanently departing Switzerland, but you're permanently departing for Germany, you may not be able to take your Pillar 2 pension distribution because you're going to another EU country. You can also, when you take that Pillar 2 distribution, there's going to be generally automatic Swiss tax withholding. And if you've already left Switzerland, you can go back to Switzerland and say, oh, you know what, we've actually already paid tax on this. When we've been filing all of our tax returns, we've prepaid all our tax. We're no longer a resident of Switzerland. Therefore, you no longer have the right to tax us. And so this is basically one very clear way to avoid double taxation on your Swiss Pillar 2 pension account. Then we have, do you want to add something to that, Celine, before I move on to the annuity?
Yeah, maybe just something practical from like a Swiss perspective, because when you research online or speak like to your colleagues, or someone who already left the country and like did the same, but is maybe not like a US citizen or is not going to the US, they might tell you, oh, you should like move your pension funds like to like a foundation, like in the canton of Zug or canton of Schwyz, and then ask for distribution because there like lower tax rates are applied, which is all true. But what Arielle just explained is because you can claim back the Swiss taxes that you paid, it does not really matter from where or from which foundation this distribution happens. So the most straightforward way is that you ask for distribution directly from your employer pension fund, because that will likely also save you in fees. Because if you go to a vested benefits foundation and you open an account there and then you ask for distribution, usually they charge a fee for for closing the account and distributing. So you can basically like skip that step and just ask for distribution right away from your employer, under the assumption that at the time of distribution, you are regarded as a US tax resident based on the double tax treaty.
Yes, and there are so many articles and ads on moving your pension. So thank you so much for highlighting that, because that's basically just it's like it does not apply for U.S. people. We have
Yeah.
a completely different setup. So thank you for going into that. And do you have to file to get the withholding back? Is that something that you help clients with, or what is your recommended process there to actually go and get the tax back?
Yes, so I mean, this is something we are offering as a service. So basically, what needs to happen is a request needs to be filed with the competent tax authorities. What is also required that is like a certificate of tax residence is issued by the IRS, because without that, the Swiss authorities will decline the reimbursement of the withholding tax. So this is something we are happy to support, and also like to monitor that then the withholding tax is paid back, because we oftentimes see that if clients are coming to us after the fact, when they're already like deported and they have closed down their Swiss bank account, etc., it might get tricky to get the reimbursement. We just had a case where the money was transferred to a US bank account. It was returned 3 times because could not be processed by the US bank for whatever reason. So we usually like recommend our clients like to maintain a Swiss bank account as long as possible until the withholding tax is refunded.
What's the timeline on that you're seeing?
I would say the end-to-end process is somewhere between 3 to 6 months.
Okay. Yeah, so that's very reasonable. Um, Anything else you want to say on that before I go to the annuitizing?
No.
Okay, cool. So then we have the idea of taking it as an annuity. So when you do get your pension statement every January or so, you'll see kind of what your estimated annual benefit would be. And so that becomes, if you are a Swiss tax resident still, so you're a US citizen and you're a Swiss tax resident, and you start annuitizing your pension benefit in Switzerland, Switzerland is going to tax you at ordinary income tax rates. You're going to pay tax on that Swiss pension benefit because they've never taxed you. That becomes a foreign tax credit on the US tax return. But from the US perspective, most of each payment, if you've correctly filed your tax returns, you've already paid tax on this from a U.S. perspective. So it's kind of like you're now getting a foreign tax credit that you don't really need. And so this is really an area when we talk about annuitizing it as a Swiss resident, or even taking a lump sum withdrawal at retirement as a Swiss resident. This is really an area where you are subject to double taxation. And so that goes to kind of the lump sum withdrawal. So again, if you are a Swiss tax resident, you can receive a more favorable tax rate, so anywhere between a 4 to 12% lump sum rate for taking out the entire Pillar 2 at one time. Again, that becomes a foreign tax credit on your US tax return. But if you only have a small amount of growth in that account since the year before, you're getting a foreign tax credit that you don't really need. So yeah, I don't know, Selim, do you want to expand anything on this kind of double taxation issue that we see?
No, I think you summarized it pretty well. I mean, that's exactly the double. Well, it is effectively a double taxation, but it's not recognized as a double taxation from like a perspective from the double tax treaty because of the timing difference, and also the fact that the US does not recognize the Swiss pension plan as a qualifying retirement plan.
Okay, I want to talk a little bit about some just additional U.S. tax reporting. So as everyone knows, you're a U.S. Citizen, U.S. green card holder, U.S. tax resident, you have an annual tax filing. So for Pillar 1, Swiss Social Security, there's no additional reporting required. It's all part of reporting your wage information. So we're not looking at a separate filing requirement or additional forms. For the Pillar 2, you're going to see that reported on the Form 8938 and then also on the FBAR. Form 8938, that is Statement of Specified Foreign Financial Assets. This is part of your federal tax filing and may apply if you had more than $200,000 in foreign financial assets abroad. And that's across all of your assets. So when we talk about any accounts that you have abroad. But those thresholds vary by your marriage status, whether you're single, married filing jointly, married filing separately, head of household, and if you live abroad or are US based. Then we have the FBAR, and this is a separate filing through FinCEN. So that's something that your tax preparer is potentially filing on your behalf. It's a separate filing, or it's something that you can file. I would say it's a very straightforward filing, but it is a separate filing. And then the Pillar 3, that's going to be reported again on the Form 8938 on the FBAR, and then potentially on Form 8621. And Form 8621 is all about foreign financial, sorry, I lost my train of thought. Passive foreign investment companies. And so PFICs are a huge tax issue for US expats. It's the reason why so many of us abroad struggle to invest, because from a US tax perspective, foreign investments, so foreign ETFs, foreign mutual funds, are all taxed punitively. And so it's really important to avoid these, because any kind of investment returns or potential tax savings by contributing to a Pillar 3 are very quickly eaten up by filing these Form 8621. So they're complex filings, and each holding that you have is a separate filing. So if you have an account and you're holding, 4 Swiss ETFs, that could be 4 different Form 8621s. And oftentimes your preparer will charge you per form. So it's just important to be aware that, okay, maybe we had some Swiss tax savings, but that got eaten up by the fact that we're already paying more in US tax, and also now we're paying more in compliance fees.
Yeah, maybe to add, maybe just to quickly to add there with the Pillar 3A, especially also with the newer products in the Swiss market, with the newer providers such as like FinPen or VIAC, where they have like automated like investment strategies, meaning they buy and sell ETFs for you, and potentially like you hold at one time like 6 or 7 ETFs at the same time, and maybe they're bought and sold like 2 or 3 times a year. If you allow that automated like investment strategies, that might just create a huge burden for US taxpayers. One, for the reporting requirements, and then also like as you already said, like the punitive like tax treatment in the US. And normally like the gains made in those investments are simply too small to outweigh like the additional cost. Like for the reporting requirements.
Okay, so we're going to get into U.S. Social Security a little bit. So U.S. Social Security contributions for U.S. employees abroad. So for many expats, if you've come here on assignment, meaning you are on an official expat assignment, you are in Switzerland for less than 5 years, you're not accepting a local contract, then oftentimes you can still pay into the U.S. Social Security system and not the Swiss Social Security system. So if you're only doing that up for 5 years, so if maybe you come here on an expat assignment and then you decide to stay longer, you would switch over. So you would go from the US system and then you would enter the Swiss system once you switch over to a local contract. We have a totalization agreement with Switzerland, so it's a US-Switzerland totalization agreement, and this eliminates the dual Social Security contributions for Americans working abroad. But you do not gain additional US credits by contributing to the Swiss Social Security program. You just receive Swiss credits into the Swiss system. The max benefit, again, this is for the US program. In 2025, the max monthly U.S. Social Security benefit was $4,018, and that was for full Social Security at age 67. So Switzerland, full benefits from 65. In the U.S., it's 67. And then this has been like a huge update this year. So the Social Security Fairness Act, it ended the windfall elimination provision and also the government pension offset program. So these provisions, they reduced or eliminated Social Security benefits for more than 3.2 million people who received a pension based on the work that was not covered by Social Security because they did not pay Social Security taxes. And so the law increased Social Security benefits for many US expats. So it used to be, and I don't know, Selim, maybe you've done this too. It used to be that when we would have clients and they would come to us and we would be preparing to calculate how much they would receive for their Social Security benefit from the US. In Switzerland, it's very straightforward. You can log in. AHV has like a great website where you can just enter your information and you can get a benefit. In the US, as everyone knows, you can log into the Social Security, the SSA.gov website, and you can get a statement, or you'll get a statement closer to, as you prepare for retirement. The problem was for people who had anywhere between like 10 and 30 years of service in the US, they kind of fell in this quasi period where maybe they didn't have full benefits. And so if they had paid into the Swiss system or other systems, we would have to do like a manual calculation that would reduce their US benefit. And so with the repeal of WIP in January of this year, now if you're already receiving Social Security, you are going to receive an increased benefit going back to January of 2024. And if you haven't started receiving Social Security yet, and you previously were going to be subject to the windfall elimination provision, you actually, when you log in and you see your statement, that's the amount that you're actually going to receive. You're no longer going to have to do this kind of complex calculation to reduce your benefit and come up with like your actual benefit. You're going to just receive what your statement is showing you. And so if you were already taking Social Security, US Social Security, those benefit checks have already started going out. And again, that goes backdated to January of 2024. There's still some updates happening with this, and so I would just encourage everyone who is kind of near retirement or potentially already receiving retirement and wondering about those increased benefit checks to make sure you're logging on to the SSA.gov website. I also will be publishing an article in Bloomberg next week on the windfall elimination provision. That's going to be coming out. So I'll try to put that in with the slides so you can read that article. And that's all about what it is and how it works, and just kind of this excitement that we have where so many US expats had been subject to a reduction in benefits, and now they're actually going to get their full benefits. And actually, before I run through this, Selim, do you have any? I don't know if you guys are seeing this in your practice, or if you have any other comments about the repeal that we had in January.
No, I think you summarized it pretty well. I mean, in our practice, we don't have too many cases that are affected by it or not yet. So I think, yeah, I think what is important for everyone who is near to the retirement age is to really like review the benefits that she or he is entitled to receive and to make sure that those then also paid out in accordance.
Yeah, and I would say just as like a general tip, when you are living abroad, if you know you've contributed to the U.S. program, I think it's a really good just habit once a year. Log in to your SSA.gov website. Make sure your statement looks correct. I think that's a really important thing that you can just kind of do to just make sure, like, you know, there's no fraud. No one's like stolen your social security number. Log into the SSA.gov website once a year, and also I would say make sure you can access the IRS .gov website as well, and log into your U.S. Tax records as well. Just making sure that everything looks how you would expect it to look. Okay, so for the pillar two, my biggest tip here is make sure you're tracking what you report, whether you're working with an external accountant who's very familiar with these issues, or you're self-preparing. It's really important that you're tracking what you as the employee are contributing, what the employer is contributing. Tracking that every year and doing that consistently is so important, because that's going to be one way that you can really avoid or reduce or potentially eliminate double taxation, right? If you do leave Switzerland before retirement, you do take a distribution of your Pillar 2 account. You want to make sure you have all of those numbers very clearly laid out. What is your U.S. tax basis? Again, every expat situation is very unique. So while Pillar 2 buybacks or Pillar 3 contributions do not make sense for most U.S. expats, we actually have worked with a number of expats where it did make sense, right? Maybe they're earning less, or they have a couple lower income years. Or maybe, again, we have a lot of clients that we work with who are married to non-US people, and it does make sense for them as part of their overall family planning. Another thing to remember is just making sure you're gathering the right documents every year, because it's always garbage in, garbage out. Regardless of who you're working with, getting those documents organized in the beginning of the year, I think is just very important. I want to get to one point here that we get a lot of questions on, Selim, about individuals who suddenly find themselves living in Switzerland and they've inherited a IRA. Can you touch briefly on this point?
Yes, of course. So maybe give a little bit of background in general how IRA accounts are treated. So, like as an example, like a traditional IRA account, Switzerland recognizes this as a qualifying retirement account, meaning an IRA account does not need to be reported for wealth tax purposes, and also the earnings do not need to be reported for income tax purposes. This also is applicable, in our opinion, for the inherited IRA account. Meaning, so if you inherit an IRA account, and as long as there's no distribution, there's no need to report any tax values of this account. For transparency purposes, we usually recommend to still report the account in the tax return, but without any tax value, so that the tax authorities are aware that this account has been inherited. One exception is are Roth IRA accounts. So Roth IRA accounts, from a Swiss perspective, are not qualifying retirement accounts. They are seen as ordinary brokerage accounts and would need to be reported for wealth tax purposes, and the earnings, except for capital gains in usual cases, are reportable for income tax purposes. Where it gets a bit more tricky is if there are distributions. Because in Switzerland, we have the all or nothing approach. So if you have like a Swiss equivalent, a vested benefits account or a Pillar 3A account, you cannot have partial distributions. Either you do not have a distribution or you need to distribute all of the amount that is in the account. Whereas in the US, there is a possibility to have like partial distribution. So you do not need to distribute all of the amounts. In principle, if you take a distribution, this qualifies under the lump sum taxation, meaning that there are preferential tax rates applied in Switzerland if there is an IRA distribution. So the same as if you had like a distribution, a lump sum distribution from your Pillar 2 or Pillar 3A account. If you now take a partial distribution, there are some considerations to be made, or just to be aware that the tax authorities might take a very aggressive position. So let's take the example that you have $100,000 on an IRA account and you decide like to take a distribution of $10,000. The best case scenario is that this $10,000 is subject to the lump sum distribution tax in Switzerland. Now, if the authorities further like review the distribution and come to the conclusion that actually on this account there was $100,000 and you only took $10,000, one position that the authorities could take is they could say, okay, we still accept a distribution of $10,000, but at the tax rate, still the lump sum tax rate at the 100,000, so at the full value of the account. An even more aggressive approach, we have not seen it happening, but there is opinions out there that it should be done like this, is that if you take the first distribution from the IRA account, that the authorities will regard it as a deemed distribution of the full amount, meaning even though the actual distribution is only $10,000, they would tax the entire $100,000 of the full account. So these are just some considerations to be aware of, that there might be pushbacks from the authorities if you take partial distributions from like a traditional IRA account or from an inherited IRA account.
And when you are dealing with inherited IRAs, is that something that you're going proactively to the Swiss tax authorities? You're asking them for a formal ruling on it, or are you filing the tax return and hoping that they accept the position that's reported?
It depends. It depends. I mean, if there's no distribution, so if it's just like a transfer of the beneficiary, there we usually do not ask for a tax ruling, because there, in our opinion, the position is quite clear, because the same principles would apply to like a Swiss account. The difference there might be, though, that from a Swiss perspective, or a Swiss vested benefits account, is you can usually not maintain the account and needs to be closed down, and you need to take a distribution. But so far, with the authorities that we have been working with, they have been accepting the regulation from the US that you can maintain the inherited IRA account.
Okay, great. And I think this is always, from a planning perspective, I always find this just really interesting, right? We have different types of accounts and they have different types of taxation. So again, that Social Security, there's really nothing we can do. It's just benefits that you're kind of going to get credited for when you go to retire. But then when we think about, contributing to a traditional IRA, most U.S. expats don't realize that they can still contribute to a traditional IRA. And I always think that's a very powerful lever. If you do owe additional U.S. tax, you can reduce your U.S. tax and still make these traditional IRA contributions. And that works if you do not have access to a U.S. qualified retirement account. And again, we know that the Pillar 2 account is not a qualified account. So it creates an opportunity because it also allows us to put assets in there that are not going to be subject to tax on the Swiss side or on the U.S. side. know we're talking a little bit about the inherited IRA, but I just wanted to sneak that point into that if you're not contributing to a traditional IRA, I think that's still a really important topic to pay attention to. Just a quick shout out. I am going to be doing another presentation on Tuesday, and that's going to be all about kind of more general 2025 U.S. tax updates and also some of the financial planning strategies for U.S. expats living in Switzerland. So if you haven't signed up for that workshop, please be sure to sign up for that one as well. It's going to be the same time, and it will be recorded, and we will be sending the recording out as a resource. Selim, we are down to our last minute here. We will be sure to send out some additional resources when I send out the recording. Please give us a few days to put that together for you. But it's been really fun. Thank you so much for joining me. I'm already looking forward to next year.
Thank you as well. And yeah, see you next year. And if anyone has a question, yeah, feel free to reach out to Arielle or to myself. We're happy to help.
Great. Thank you so much. See you soon.
See you. Bye.